Yeah, what happens is there's a printing press frenzy, a free-for-all, basically. And it usually starts rather slowly, and then it morphs into what's happened during all great inflations. We have something, it's three words, all fiat fails. Let me repeat, all fiat fails. There's never been one instance in all recorded monetary history where when you were taken away from a grounding in gold and or silver, bimetallic's better than just gold, but I don't have time to go into it. You get to basically a runaway inflation, and the currency is destroyed. So this is the path we're on. If you look at the $1913 at 100 cents, if you go to the Federal Reserve Board's own website and check out what the $1913 is worth, they'll tell you it's worth about 2.5 cents. So if you lost about 97.5% of the value of the US dollar within a little over 100 years. So gold would actually maintain, let's say, a policeman on the currency's value, but it doesn't at certain times in history like we're experiencing. If you want to know what the paper price of gold is, it's a very simple thing. All you have to do is go to the US debt clock and look at what M1 is. And then you go to the Treasury and find out there's 265 million ounces of gold purportedly in Fort Knox. So you take the amount of printed money, divide it by 265 million, you've got the numerator, dollars. On the top, you've got the ounces of gold. At the bottom, you divide, and you find out it's over $10,000 for an ounce of gold. And that's just base money. That's currency. That's what's in your pocket. That's your checking account and what you have in foldable money, or currency, I should say. Mm-hmm. So there's that. So that highly suggests that at less than 2,000, gold has a lot of room to the upside. But you don't see the move in these metals during some of these, let's say, financial repressions, Jason, because the government's very good at spoofing the market, telling everybody that inflation is low, making metrics that don't make any sense, doing this hedonic indexing, doing a lot of things that basically ignore the truth. And so people get used to it, and numbers are numbers. They get the idea, well, I'm making more salary, things can't be too bad. Very difficult, because you do get these cross currents, and thank you for chiming in. So what happens is, as the currency depreciates more and more people wake up. And the one place it's really hard to hide is food. So everybody has to eat, whether you're rich or poor, it doesn't matter. So when you go to the grocery store and you notice, on a weekly basis or a monthly basis, some goods that you buy, almost every trip to the grocery store continuing to go up in noticeable amounts, meaning like 20% or whatever, people really catch on, and anyone that has any savings basically starts to think about what's happening to their purchasing power. And what they'll do is move into buying, another case of tuna fish as a hedge, or, more cereal or whatever. And the other thing about inflation is that through all inflations, and especially in more modern times, is a good trick that's done often, and this, Jason, is that box of cereal will cost the same price, but instead of being 20 ounces, it's now 14 ounces. Well, thanks. I think you gave a good precursor to it. I think it's both. I think, one, there's a lot of diversion, crypto this and crypto that. So a lot of money that probably go into the metals have gone into the cryptocurrency. I'd call it almost a mania at this point. Not that Bitcoin's not going to be worth $1 million. I don't know. But what I do know is that one is a diversion. And the other one is lack of knowledge. The people don't understand money. They don't really understand the difference between something the government tells them is money, which is currency that can be printed to infinity, and an ounce of silver or an ounce of gold that's traditionally, over a long period of time, held its value against all commodities. So it's an education process. But I think what's going to happen is, as the general markets deteriorate, meaning the bond market and stock market, you're going to see people seeking what is real. And since everything else is pretty much overpriced, you will see a run to gold like you've probably never seen before. But that's my take. I mean, I'm old school, and I went through the 1970s and watched the whole thing happen, and it really looked to me like in January 21st, 1980, when gold peaked, we were pretty near a currency crisis, and gold was signaling that the US dollar was going to fail. And Volcker came in and said, I'm putting interest rates up to 20%. Well, at the time, 20% was like mafia money. I mean, that would be a loan shark on the street that would demand you to pay 20%. The best thing you could have done is what one of my friends did. He sold all of his gold and bought the long bond. So for 30 or 40 years, he's gotten a coupon of like 17, 18, 19%. And as interest rates go down, bond prices go up. So that was like the absolute best investment you could have made in the latter part of early in the 1980s. So this is a very, very interesting chart because it takes the inflation lie out of the price of silver. So what that means is that $400 back in 1344 is the same as $400 in 2004. So now we can get an inflation-adjusted price for silver. And as I did a lecture on this, or actually a podcast recently, a few weeks back, and what I pointed out was in 1344 to 1544, the average price of silver was well above $400 the ounce. So the problem with silver, if you want to call it a problem, is when silver is equal to gold. So if silver is treated like gold as a monetary asset, and it's only money, it performs pretty well relative to gold. But when it's treated as just a commodity, it doesn't do that well. So if you go these 200 years, silver is above 400. And by the way, the all-time high, inflation adjusted, was $806 an ounce back in 1477. So we had that 200 years or so of $400 silver, then it dropped down in this range here, and it maintained about $200 an ounce from roughly 1584 to, we'll call it 1764. And then it dropped again, and we were around $70 an ounce in 1804 to 1904. So for 100 years, silver's purchasing power, real true price, inflation adjusted, was about $70. So during the crime of 1873, right about this point where my cursor is, silver was demonetized. The bankers went on a gold-only standard, and you couldn't use silver in monetary transactions for about 4 years. As this inflation becomes more viable to the average person, they'll start to seek ways to protect themselves. And the wealthier will look to gold, and the less wealthy that have savings will move to silver. Mm-hmm. And I think the only way it happens is, my people suffer for lack of knowledge. Most people don't know monetary history. They don't really care about monetary history, and they really have no conception of gold and silver. It's not anything that you hear on the Wall Street talking heads ever. I mean, very rarely, let me put it that way. So people have to wake up, word of mouth. But what's happening is we're seeing that. This is what gives me faith that the next leg up is going to be rather spectacular, because the Wall Street Silver Group has gone from a startup to, I think there's 45,000 people in that group. And these people are mostly younger, and they're educating each other about the merits of an honest financial system. Mm-hmm. And so they understand that silver cannot be inflated away. It's always going to be an ounce of silver. What varies is how much currency is printed against that ounce.